Hey, everybody. Thursday, August 27th, 2020. It is the weekly financial thing live stream, and we discuss all things peer to peer lending, investing, and whatever else you would like to discuss in the finance world and investing world. What do we have today? We have some assets capital discussion that I think most people who is an assets capital investor will have seen what's going on with them. Some rate setter news. Just scrolling down my list. Zopa, LoanPad, a little bit of Able rate news, and OnStep Homes, who I had a chat with this week to get a rundown on their new peer-to-peer lending product, which OnStep is actually tied to the excuse me, the Unbolted company. I wasn't really big on the product at first when I started reading about it, but I had a chat with the powers that be over there, and they just gave me a clearer understanding of how it works. So, I'm going to give you a little overview of that, my thoughts on the product. As always, we will go down the list and chat about everything peer-to-peer lending. So, if you have questions, go ahead and pop them in the comments. I always enjoy reading your weather updates. Very traditionally British, right? We get onto a finance live stream and we talk about how the weather is. So it always makes me laugh. Please hit that thumbs up button if you can take a moment to do that. That helps me with the YouTube search and algorithm. If you haven't already done so, please subscribe to the YouTube channel also, and come join us at the Financial Thing Facebook group, which is where we discuss all things peer-to-peer lending and investing. Bingo. We're also going to talk about index trackers this week. What's going on? I've done a test investment through Fidelity that I started in June. And I've always kind of been a big proponent of Vanguard, but there's a couple of things about Fidelity, about their trackers, that I actually prefer. Particularly the world tracker. If I was going to pick a world tracker, it would likely be the Fidelity one. And also, there's some advantages to Fidelity accounts. For instance, if you want a joint account with multiple people on it, you can do that through Fidelity and not through Vanguard. So, kind of chat about that and how those results have been since June 2020 when I did the test investing. Quick disclaimer: this information is not financial advice and has not been prepared without taking your objectives, financial situations, or needs into account. You should consider its appropriateness for your circumstances. All investing carries risk, all investing. And the opinions expressed in this review are opinions based on my own personal investing experience. And remember, the FSCS does not cover peer to peer lending investments, and your capital is at risk. Please don't invest more than you can afford to lose. Speaking of that last line, very important. Please don't invest more than you can afford to lose. There was a news story about a woman, I believe it was a veterinary surgeon, who had 140K locked up in Lendy when it froze. So a little, we'll do a discussion about that. But quick hello to everybody. Hi, Aki and Accrington, Colin in the Peak District. I presume it's just windy and wet all over the UK. So John, hi in Nottingham. Stephen in Southport. Alan, hi. Nice to see Alan Toombs in Soaking Basingstoke. Maybe renamed as Basingstoke. Okay. And Chicken Boy, hi to you. Nice to see you, Paul, in a very rainy Kenilworth. Peter in Leatherhead. Chimpo Naughty. Darren in Cambridge. Richard in Southampton. Nice to see you back. Richard, we missed you. Stephen in dull and wet Nottingham. Hi, Mike. Mike is here and he's dried out. Tony in soggy Somerset. Brian in Woburn. And if you anybody else who pops up in the chat will get themselves a hello if you want one. So let's get right down to what's going on this week. So assets capital, I've talked a lot about assets capital in the past and that provision fund. That assets capital was never really a company that was built around a provision fund business model. Like someone like RateSetter is very much their entire business runs around their provision fund to protect all of the investors equally. Now, Assets Capital and does have a smaller provision fund. There is some amount of money in those provision funds, and each provision fund separately covers the loans in a particular account. So the quick access account has its own provision fund, as does the 30-day and 90 days. So any of the access accounts. And what they've sent out this week is a note to current investors that if there is not sufficient money within the relevant provision funds to fully cover the assessment of the loss given in a default, then the loan will not be allowed to trade within the access accounts, thereby preventing lenders from gaining or increasing a holding in a loan which is in difficulty and which may ultimately face a loss. So, in plain English, what that means is if a provision fund doesn't have enough money to cover a particular loan, then it no longer becomes something that can be bought or sold within an access account. And what that means to most of us right now, and especially anybody that's trying to use the access account exit feature, is that if a particular loan cannot be covered by a provision fund amount, then it can't be sold, which means that that loan would be removed from an exit possibility if you were trying to exit. So, real world example, if you had 100 pounds of loans you were trying to sell and 10 pounds of a loan was in a defaulted loan that wasn't covered by the provision fund because the provision fund didn't have money to cover it, then you would only be able to sell 90 pounds of loans instead of the 100, which would mean you'd have 10 pounds that would be sort of stuck in limbo because it's technically in default and not covered by the provision fund. Again, the reason why provision funds have always sort of been a bit of a widely debated topic in peer-to-peer lending, because what they do is they do provide extra protection, as you've seen with Assets Capital and other peer-to-peer companies that cover defaulted loans with or late payments with provision funds. Problem is that usually the provision funds take away from lender return rates. Real world example, you've seen that in RateSetter recently, where they've absolutely halved all of their returns so they could put money into the provision fund to pad it. So the lender's return rates go down, the provision fund increases. And you've seen that with LendingWork, to a more extreme example where complete freezing of repayments of interest to lenders while the provision fund is bolstered. So it does have a negative downside. While it provides protection, it can reduce returns in some cases. Assets Capital's provision funds were relatively small to begin with compared to its loan book. I took a look at the provision fund situation for each of the 3 different access accounts as of June 30th. The 90-day had only 20,000 pounds of available cash in the provision fund, whereas 1.64 million pounds of cash is already being utilized in the provision fund for either late or defaulted loans. So this is why this is happening. The statement that they sent out is on that 90-day account, for instance, there's only 20 grand left in the provision fund to cover any future poor loans. So there's no money basically left in the provision fund, while 1.6 million is already being utilized to cover existing loans that may not be performing or are not performing. If we look at the 30-day account, similar situation in there, a little bit more in the provision fund. In the 30-day account, 60,000 pounds and 1.67 million of funds being covered for loans being covered. So only 60K left, and the QAA 70,000 left, and 1.32 million in the quick access account that is currently ring fenced to cover loans that are non-performing. So, what Assets Capital is saying that they're trying to explore potential alternatives to ring fencing that would allow these loans that are in trouble to remain tradable, even if there's not enough cash in the provision fund. So, basically, this is a terms and conditions situation that they have. Their terms and conditions and policies set out the provision fund, and they're coming to a point where due to COVID and what's happening, they're probably seeing an increase in late payments and defaults, and therefore the provision fund is becoming depleted. And really expected if you think about it. We're sort of getting to the beginning now, I think, of where we're going to see the fallout of what the COVID economic environments are doing to small businesses, and now you're starting to see that impact on a company like Assets Capital that does provide small and medium enterprise funding. And I'm not really too surprised about what's going on with their situation with the provision fund. I think a lot of people are going to be put off by that because maybe they didn't really understand how the provision fund worked. And I've seen a lot of people on forums saying, "Well, I'm gonna sell out for a discount because I don't feel comfortable with the what's going on with the provision fund situation." I was kind of a situation that I expected would happen. I've said it before that the provision funds are relatively small, and that we would see that knock-on effect from COVID and business lending. So not too surprised. Uh, I looked this morning at how much the discounting was if you wanted to access the QAA and exit of the quick access account. You were looking at about an 8.3% haircut this morning. I think that this announcement has sort of, again, made people run for the exits, and the discounting has been relatively high. I personally wouldn't sell my loans in 8.3% discount because I do think the assets has a viable business model, and I'm not too concerned about what's going to happen in the future with them. If you look at the way Assets Capital creates revenue, they have a pretty good amount of fees that they make from loans. So they get 7.5% of any loan facility. So if they write a loan that's $100,000, they make a £7,500 fee on that, and then they get a 5.5% per annum loan monitoring fee based on the loan outstanding. So if there's £100,000 left on that loan, they would get a £5,500 fee a year to exit it, monitor it. And also there's a 2% exit fee that they list. I don't know if that means an early exit fee. If somebody wants to pay off their loan early, I have to pay 2%. So they're generating money and they're generating fees. And I think it's a viable business model long term. So I'm not necessarily running for the exits, but I'm playing defensive in peer-to-peer anyways right now. Definitely not increasing my investments in most peer-to-peer lending situations, and just withdrawing interest, and in some cases some capital repayments when they're made. So I think the defensive view is the way peer-to-peer for me right has to be at the moment with what's going on in the economy, and that might likely change once things settle down. But again, we don't know really when things are going to settle down. So I'm not necessarily running for the exits. Again, it's not the ideal situation. But it's expected what's going on with the economy and what's going on with small businesses that are going to get hit by these shutdowns and COVID problems. So that's the Assets Capital news this week. RateSetter. I finally this week, it was a thumbs up because I was able to exit some money on the 5-year investment. On August the 25th, I finally got out of a part of a 5-year exit on the 5-year product. Took, let's see, it started on March the 13th. So April, May, June, July, August. It was 5 months, a little bit over 5.5 months to exit. and that's the 5 year. The 5 year product exit is definitely moving a lot quicker than Access. I've had some readers tell me that if they try to exit now, they were at number 20,000. When I started in March, it was 2,000 or 1,800. So there's definitely a lot of people that are trying to exit from RateSetter. I'm happy that it appears to be, aside of the Access moving very slowly, the 5 year account is still moving and people are able to get their money out. Again, no guarantee with that, but it is moving forward with the sales on the 5 year product. I don't have anything in the 1 year, so I can't comment on that, but I presume the 5 year and 1 year products are moving the same direction with the exit. So we'll see what happens with the Access. I'm starting to be a little bit less optimistic about RateSetter as a future place where I park peer-to-peer money now. Not because I think the business is in trouble. I think that the Metro Bank sale is going to go forward, and I think that will provide RateSetter with a pretty stable foundation to continue forward. But what I think is happening is that RateSetter is just not making money, and likely that their current peer-to-peer lending model cannot continue indefinitely in the future. Obviously, the rates are just super unfavorable. 1.5% on the Access for Now account return. It's not great. So my personal feelings are that until things stabilize with Metro Bank, and we know what's going on right now, the communication obviously isn't there because the Metro Bank deal isn't finalized. So RateSetter can't really tell us what's going on with the deal. And I think a conservative way to look at RateSetter would be to sit on the sidelines until the Metro Bank deal is finalized and communication moves forward to peer-to-peer lenders about how the business is going to continue to operate in the future. And if the rates change, then maybe that view would change. But for 1.5, for a 2% maximum interest rate, there's just doesn't make any sense for a new investor to invest through RateSetter at the moment. See where you can get a percent on a national savings and SNI access account that's covered by the FSCS. So it's kind of unfortunate for RateSetter because they've been it's just bad timing with what's going on with COVID, and I was a fan of the business, but it is what it is, right? Again, the exit situation has been very positive. There's a lot of RateSetter bashing going on, I'm sure, because of those rate cuts, but so far this month they've exited 9.2 million pounds to lenders, so they're still continuing to provide exit, and 1.7 million pounds this week. You can't really hate on them for that. They are providing exit, and it is taking a long time for some people, especially the access accounts. So yes, not access anymore, but it's still, the liquidity is still continuing there. So that's the best case scenario, I think, aside of being able to exit your money straight away, which would be the best case scenario. But during this time, to see the progress moving forward is pleasing. So I don't know. Let me know what you think of the RateSetter situation. I know a lot of people have money in there, as do I. So let's talk about Zopa. Zopa released their savings rates to the general public this week. If you were sorry, let me rephrase that. I don't know if you were a peer-to-peer lender, but I know I've still got a little bit of money with Zopa, so they offered the promotional rates a couple of weeks ago that were slightly favorable if you were a current peer-to-peer lender. For instance, the 1 year rate that they were offering to peer-to-peer lenders or existing investors 1.1% versus 1.05% to new investors. And then the 2 year term was more favorable to peer-to-peer lenders at 1.4% to take the fixed rate saving savings rate versus new investors, we're going to get a 1.15%. That's a pretty good drop there, talking about a 0.25%. 3-year 1.5% versus 1.26%, so on and so forth. Again, doesn't really excite me even at 3 years at 1.5%. For me as a current investor, I wouldn't have taken it. Just don't see the point when you can get NS. And I account for not much lower than that. Not really sure what Zopa's play is there when it comes to being able to attract new people, but seems like they've got something in their mind and that they are able to do. But I don't really think it's very attractive, and it comes down to rates at the end of the day. If Zopa's FSCS protected now on their savings side, then you don't really look at the business too much anymore. You just look at what the rates are, and the rates are not really attractive. So I'll take a pass on that. Now, what they're doing now is it's interesting. They sent out an email. So Zopa Bank now is writing loans, and then they are randomly assigning those loans to the peer-to-peer business and to Zopa Bank. And when I say random, I'm presuming that it's completely a computer algorithm that decides, okay, loan number one has a 50% chance of going to the Zopa peer-to-peer lenders, and has a 50% chance of going to the banking sign, or maybe, well, I don't know. I don't know how they decide which loan goes which way. But what they say is that they are assigning these loans that they are writing through Zopa Bank and to peer-to-peer lenders, or keeping it under Zopa Bank. So then that shows that they won't write loans that they wouldn't approve to hold themselves in their Zopa banking side. So, I mean, sure, it's fine. And it goes to show, yes, they do have some confidence in the loans that they're writing, that they're willing to hold them themselves, which they should. I mean, you can't just write loans as a bank and dump them off to your peer-to-peer lending business, because, yeah, that wouldn't be cool. What I think is going to happen, I think Zopa will eventually phase out that peer-to-peer lending business, and they're just going to turn into a regular old bank. I don't think that peer-to-peer lending business has been that great. It's a lot of the rates they advertise obviously have dropped a lot. But they are one of the oldest players in the peer-to-peer lending business, one of the big three. Definitely the first one that started in 2008. Sorry, first one that was able to ride through the 2008 recession. So, it's kind of interesting to see how their business model has evolved into a bank. But obviously, they're going to do what they think is the best thing for Zopa. So, saw a interesting news article about British Pearl. That they decided to put their property portfolio up for sale. I can't remember when they did that, but I have a feeling it was either right before COVID happened or right after COVID happened. But they said that they're trying to make their platform available in other parts of Europe and Hong Kong, and they don't have any faith in the UK property market. So they're selling their property portfolio. And quote from them, "We are not buying more property in the UK because we believe it is the wrong time to enter the market." So that brought up a question for me. I was thinking, well, if it's the wrong time to enter the market, why sell when it's probably not a good time to sell either? So I was curious about what their plan is. I was not a British Pearl investor. I did go to visit them once, but it was never really a business that I was interested in investing money through. So yeah. So what's going on at LoanPad this week? 12.2 million pound loan book. It's increased about 600,000, and they have a loan book secured value of 47.57 million, so about 26% average loan to value. Still seeing a good uptick in lenders. It means that new lenders are coming on board, shows confidence. 27 loans still. Average loan size 421,000. Their interest coverage fund, which is their version of a provision fund, has they've got a £40,000 coverage fund, and last week I believe it was a little bit less than 11,000 that had been paid out to cover non-performing loan, and this week it was up to 11.8k, so 11,800. So it's gone up a little bit to the amount that's been serviced by that interest coverage fund. They have some loans that have been extended this weekend. They have a new lender that I've noticed. Somebody brought my attention to actually on Facebook. Blockvale is now one of the lenders aside of HAMF. I did take a look at Blockvale. Couldn't really find much information about them on Companies House. Seems to be a real estate bridging company of some kind of real estate group, but they don't include their profit and loss statements on Companies House, so it's hard to get a read on how big Blockvale is or what their financial situation is like. Thankfully, I have a phone call in the next few days with LoanPad CEO, and we'll have a chat about Blockvale, find out why Blockvale was introduced as a new lender, and if HANF was slowing down on their deals. I got some questions about that. Louis is always happy to answer, so I'll have a call, and then next Thursday when we have the stream, I'll be able to give you more of an update on LoanPad's new lending partner. On LoanPad's website, in the loan document, they write that Blockvale is an established bridging lender forming part of a larger family-owned real estate group. LoanPad has a long existing relationship with them. This loan was actually quite a big loan. The LoanPad did through Blockvale. It was a £650,000 loan. Blockvale lent out 270,000 of that. HANF is usually the other way around, where HANF will take a larger stake in the loan than LoanPad, so a little bit reversed on that. Has a 90-day valuation of £3.2 million. It's 2 4-story houses in London. So again, 90-day valuation of 3.2 million. Regular valuation, I think it was 3.6 million. So that gives a 20% loan to value. Again, very conservative for LoanPad. One thing I was interested about why they used a valuation from November 2018. Sure, there's probably a good reason, but I noticed that the valuation was a little bit older on that. But again, I have full confidence in LoanPad, and when they bring a new lending partner on board, that it's definitely someone that they have a good relationship with, and they're not just going to pick any bridging partner lender and bring them into LoanPad, because they just don't do that. So happy to see that. For everybody that's asking, what about these peer-to-peer lending companies that pay these higher return rates like Able Rate? I always say this: first of all, diversify, and that when you're being paid a high interest rate, you are usually seeing a great uptick on risk, and there are going to be loans that run into some difficulties or problems. There's a note from Able Rate this week about they have a secured basket of loans through a company called Access, and it seemed like, from what I could read, this is what was interesting to me. When they send out these administrator notes, it's usually that the loan is being either restructured or maybe there's some issues with repayments. They sent out a note and it said, "We have looked at cash flows within the company and taken into account continuing COVID uncertainty and have agreed that a restructure of the loans are required. We would rather work with the borrower to have a sensible repayment timetable at this time than have a timetable of payments that may be a stretch if the COVID situation bites further. We also want to move away from pure interest-only payments, which are only a temporary allowance for some loans." So, what's the point of all of this? The point is, again, this is a loan that potentially could be an issue. Don't know right now if that Access company is having any issues, but it sounds like something is having to be restructures, which, again, remember, if you are investing in high interest rate peer-to-peer lending, which I think some of these able rate ones with 10%, 12%, 15% paying loans, just be careful, because they are going to have loans that do run into issues, and buyer beware, on really high interest rate loans. It's not, again, Able Rate is a company that I don't have a lot of money invested in, because I just don't, I'm just not willing to take those high risk loans anymore for that high return payoff. Just been too many ones that have gone pear shaped. So yeah, that's what's going on with them. Again, On Step Homes, I had a call with them this week. I was interested. I last week I said that, or a couple of weeks ago, I probably wouldn't look at On Step because of the return rates were pretty poor. And Rito from On Step reached out to me and said, "Hey, I just want to explain what this peer-to-peer lending product is that we're arranging." And I do have a lot of respect for Unbolted and what they're doing. So I thought, well, let me talk to Rito over at OnStep and Unbolted, and let's find out what's going on with the product. Basically, what they do is they have tenants that want to buy houses, but for whatever reason they are not able to get bank financing. So it's basically like a rent to own option. They call them in the US lease options. So basically, the tenant sources their own property and they find a house that they like, and OnStep goes to the crowd to finance some of it, and the tenant puts in between 5 to 10% of their own money into the property. The tenant then signs a 7-year rental agreement, which is inflation linked. So they have a 7-year rental agreement. Tenant improves the property. It's an ISA eligible investment and capital gains tax exempt because it's considered an equity loan. After 7 years, what happens is the tenant decides they can either refi, they can either buy the house, or they can move out of the house. They can exit their loan agreement 5 years out after purchase. So if they're in the house for 5 years renting and they decide they don't want to rent it anymore, and they're going to forfeit their 5 to 10% investment that they've made, they can do that after 5 years. So yeah, it sounds like a decent idea in theory. There is obviously some risks. What does the peer-to-peer investor get out of this deal? Well, they're going to get a 3% inflation-linked rent payment. So year one, it's 3%. Year two, 3%. It goes up a little bit as time goes on, down to year seven, 3.3%. So I mean, it's not great, but it's kind of standard rental yields for that type of investment, 3 to 3.3%. And then what happens is that peer-to-peer lenders put their money into this house, would share in the equity on a sale. So let's say if the property goes up 100,000 in value over 7 years, you would remove how much the tenant has put in. So let's say the tenant puts in 10%, so 10,000. So there's a 90,000 pound gain, less expenses, whatever those fees and expenses are. All of the peer-to-peer lenders would share in that equity as a profit share. So you do have the potential, if the property market continues to rise, that you could potentially have a share in that increase, whatever that is. Of course, on the downside is, for some reason the property is worth less after 7 years, you would incur a loss as an investor. If the property is bought right, then probably not much chance that the property is going to be worth less than 7 years. But again, it's kind of speculative, because when you buy into this type of investment, you really don't know how much that property is going to appreciate over 7 years. It may go up 10,000 instead of 100 grand. Who knows? And obviously, your returns wouldn't be very good. So there is some speculation. It is a nice idea, because what it does is allow, again, people that maybe weren't able to get into houses because of whatever situation, maybe they can't get bank financing, to be able to get into a house and have their own equity inside of it. So tenant has skin in the game, which is good for investors. You always want skin in the game. And then a 7-year guaranteed rental agreement. The tenant is going to be very likely to want to see it through because they have 5 to 10% of their own money into that house. So walking away isn't going to be really financially good for them. If they are buying a property that's 300 grand, they're putting in from 15 to 30,000 pounds of their own money. That means that the tenant is going to take care of that property, probably do their own improvements to it to make it better. So you have a good tenant. I mean, on Step's website, they call it a dream tenant. So I can see that. I can see the benefits of that side. And you're doing something to help somebody if you're into ethical investing and things like that. On an investor side, minimum of 100 pounds in per peer-to-peer slice. Yeah, and again, it's the people behind Unbolted seem to be doing a good job with Unbolted. I'm not sure about what their extent when it comes to property lending is. Don't think they're quite as experienced on that side as they are in the pawn broking side of things. So there is that to think about. They do have a secondary market that you can trade peer-to-peer lending parts on Step. There aren't any at the moment because they've only done one deal. So this is a new launch. So it seems interesting. I mean, I'll probably look more into it. I'm not hugely big on things like equity pieces on loans, but once I look more into it, I'll be able to give more of a general feedback on what I think about it. It seems interesting. I'm surprised there aren't more real estate people doing things like this because buy to let, whereas the tenant has equity into the house, seems like a really good fit for them as a tenant and for the investor having a good quality tenant in there because of the tenant having skin in the game. And it's interesting to take that as a peer-to-peer business and to do that. So yeah, kind of cool. Oh, and by the way, OnStep doesn't charge a huge amount for their fee, so which is good. They do 1% of the purchase price. So yeah, well, that's very reasonable. They can make money if they can get their portfolio large enough, and I don't think they'll have a problem finding people that want to own their own houses that would be open to a program like this. I think they're just going to have to build trust. That might be difficult at the beginning to build trust with the actual tenants and who are saying, "Hey, we'll buy the property for you, but you got to put in this amount of equity yourself." So we'll see. What else? So Fidelity, yeah, I bought some index trackers on June 16th. I kind of wanted to see the performances. And what did I buy? I bought the US Index Equity Fund, which is the equivalent of Vanguard's US Equity Fund. And I bought the Fidelity Index World Fund, both accumulation, not income. A little bit of the Global Bond Index, Vanguard's Global Bond Index, and a little bit of Vanguard's UK Long Duration Gilt Index Fund. Very, very small amount. I just wanted to test it out and see, what it would do. And the funds have really been pretty good on the equity side. As you know, the stock market's sort of raging right now. It's crossed over 28,000 points in the Dow. So not surprising to me that these funds have done pretty good since June. It's up about 5.3% on the US fund, 4.22% on the world fund. And that's sort of what I've said about, people say, why don't you buy a world tracker? And the world tracker is just generally a lag behind the US tracker in performance, even historically. And that's what I've seen here. I do actually like the Fidelity World Tracker more than the Vanguard one. It just has a performance has been a little bit better, and I don't know. I like it. I'm not as big on the Fidelity US equity tracker. It just doesn't have as much diversifications. It's only 505 stocks inside of the tracker versus Vanguard, which is 3,500. But they performed pretty similarly since June. So the Fidelity one 6-month return 10.9%, Vanguard 12.48%. So there's a little difference there. And so Vanguard's fund now is 8.5 billion in size and Fidelity's 2.1 billion. So there's pretty huge adoption into the Vanguard one. Again, 505 stocks in the Fidelity, 3,500 stocks plus in the Vanguard. On the World Fund side, the Fidelity World Tracker has done 6.9% last 6 months versus Vanguard's version 6.3%. So about a 1.6% difference. In the negative on Vanguard's FTSE All Cap Index World Tracker, which I consider that equivalent to the Fidelity World Tracker. The Vanguard fund is pretty small. It's $500 million. Yeah, $500 million, right? Small. And the Fidelity about 1.6 billion on that world tracker. The reason the Fidelity one has done better is because it's slightly more weighted to US stocks, about 64% on Vanguard versus 57%. And as you've seen, US stocks have really been performing really well. So you're seeing that increase on the returns for the Fidelity versus the Vanguard. And the yield is slightly better on the Fidelity. It's 2.63% versus Vanguard's 1.92%. So if you're getting a 70% a 0.7% increased yield on the Fidelity fund, it's probably going to perform better than the Vanguard one. But yeah, I think those funds have done pretty well. Again, I'm more bullish on the US, always have been. Just I like the companies in the US and the tech, but I wanted to test out both to see how it's doing. What else? Oh, I saw a Halifax deal. I was just browsing the internet. This is a pretty good deal if you're looking for a current account. You can switch your existing current account. Halifax can give you £100 free. As long as you put in £1,500 a month, it's free, or it costs £3 a month if you don't. So just something I spotted. I thought was a decent deal. And what else? Yeah, that's pretty much it for this week as far as the news. Going to try to keep it under an hour today. Please hit that thumbs up button if you can. If you have a question, pop it in the comments. And we will see what's going on the side of the rain. Mike Powell says Access is their loan introducer. Most of the loans on the platform have some link to them. They also operate the Huddle platform. Okay, thanks for that information, Mike. And Mike says OnStep. It's OnStep too, by the way. I think I kept on butchering that name. I kept saying One Step, and it's OnStep because I was searching on the internet for One Step. I couldn't find it. Mike says, in theory, the requirement that the tenants improve the property should improve the value subject to market. Yeah, market fluctuations. I agree. I mean, it makes a lot of sense if the tenant has skin in the game and they have a interest in keeping the property in good shape and actually improving it with the long-term goal of buying it, then yes, the property you'd think would be able to increase. John says regarding unbolted high net worth loans can increase investors' average loans significantly from experience this week. Yeah, I don't have much input on that. Yeah, I agree. I don't think Unbolted is, by the way, when I talk to Rita about Unbolted, about their business model and were they going to change it? Because that's always one of my concerns with a peer-to-peer platform that seems to be doing well. that they start to change and migrate into different types of business. And they said they're on the unbolted side, they really don't have much of a want to make that business really large or to scale it, because a lot of the loans are in the uh, smaller size. And also, he said that they've passed on a lot of loans that, or not a lot, let me rephrase that. They've passed on some loans that Funding Secure ended up underwriting. So it seems like they're a lot more conservative. One of the things I said to Rito was that the complaint about Unbolted is there just wasn't enough loans on the platform. So there was some cash drag. And he said, yeah, it was just we're picky about what we put up on the platform. So the other good thing about OnStep is their platform is, I think it's a lot better than Unbolted as far as their technology side of things. Unbolted is a little bit rough around the edges. So I haven't gotten my head around the OnStep all the way yet, but I think it's going to be a success project if they can get people to buy into it. It's a difficult time right now because not too many people are running into peer-to-peer lending, so you've got to get the investor confidence back. So they're gonna have to do some work on that side of things, but yeah, I think they'll be able to do it. So Mike says, Mike posted something on the Mike Powell posted something on the Financial Thing group about the FCA. So the FCA is giving you an opportunity to have your say in the future of how the FCA complaints and compensation scheme works. And he posted a message on the group that he would encourage people to input their thoughts and feelings into that. I'm going to post the link here. I think it's important for people to do that, especially anybody that's been through the debacle of the Lendy Funding Secure collateral problems that the FCA, that you do take an interest in that in the complaints process. Mike said on the post that if you've not complained yet to the FCA, any complaints received after the 14th of September 2020 will be possibly treated under the new proposed complaint scheme, which is likely to limit further, if not rule out, compensation payments even more so than the existing scheme. The FCA is hoping to make changes to how its complaint scheme works and finally rule out any possibility of it recommending levels of compensation for those affected by their regulatory failure. So basically, if FCA makes a bad decision and people end up with losses, that there is going to be no possibility of material levels of compensation because of their blunders. So that's an important thing to fight for, that we want to be able to have rights to have possible compensation if the FCA does make a mistake. So, yeah, go to that link and let your thoughts be known about that and put your input in. People tend not to get involved in that type of thing. They just ignore it and say, well, what's one person going to do? But, one person can do something and make a difference. So definitely put your input in on that if you can. I'm sorry. Oh, apologize. Yes, Mike, you're right. It was Mark Mason that posted it, not Mike Powell. I always get you two confused because you're both involved in the action groups. Mark, Mike, Mark. So apologies for that, but it was Mark. Again, important. Check that out. Aki Chap says Metro Bank are offering up to £250 for referrals, so it looks like they're in a pretty good position after the rate set a takeover. Well, they haven't taken them over yet, but it does look like it is going through. And I think there's a very, very high likelihood because there's been a filing of rates that are releasing their Australian ownership shares. So they probably have to do that for the Metro Bank takeover. Patty says, my question is about 25 up the list. Patty, I'm going to try to pronounce that name right. Patty Gilfillan. Sounds very, very Irish, Patty. Let me see if I can find your question. It looks like, with a queue of 21,000 order rate setter, what's your view on an offer to take a 10% hit to cash out? Personally, I wouldn't do it. I think that rate setter will be okay in the long run, but depends how much you're talking about, right? If it's not much money, then take the hit and get out and sleep well at night. But if you're talking about a substantial amount of money, I would probably think twice about it, or maybe take a percentage of that and then take the hit on a percentage. But not me. Not, I don't think I would take a 10% hit. Hope that answers your question. Chica Boy says, have you noticed that it's mostly boys and men who invest in peer to peer? I wonder why it's mostly a male trait. Could it be because men have more money than women? No, Chica Boy. Well, number one, I don't know if that's true or not. We don't know. We don't know who is investing in peer to peer, but I don't think that men necessarily have more money than women. I don't know. I think men tend to be a little bit more willing to take a more heavy investment risk than women do. Maybe, I don't know. I'm not sure. There was a news story too about that woman from, like I said, put in that she's got 140,000 locked in on Lendy when it failed, and that it's likely slowed down her retirement. Let me pull that story up. If you ever wonder if you have too much money into one platform in peer-to-peer lending, go read that story. I don't have a time subscription that's under a paywall, but I can pretty much guess what the story says. Catherine, I know Catherine's on Facebook on one of the groups. I think it was the Lendy Action Group, and it said that she had 140,000 in her lending account when it was frozen. The money was to fund her retirement. She has to put on hold now until she knows how much she may get back. Yeah. What the story doesn't say is Catherine, how much did Catherine have in particular lending or investments in general? If she had 140 grand out of 10 million of her investments, it's not so much of a big news story, right? But if she had her entire allocation of peer to peer inside of Lendy, then that's hugely much more impactful. I'm not saying that losing 140,000 is a big deal. It's huge. I guess it depends how wealthy you are. And, if Boris Johnson lost 140K, it probably wouldn't be that much of an impact to him. But for me to lose 140K, I would be swearing at everybody right now. But yeah, so a good lesson in, diversification. Don't put too much into any one peer-to-peer lending company because you just don't know what could happen. It's definitely a shame. I hate to read things like that. I definitely have a sour taste in my mouth about the whole Lendy situation. Having money in there myself. But yeah, diversify. If you're just unsure, don't invest at all. Just sit out and, invest in safe things that you think are safe, like bank savings. Then you have to worry about inflation eating up everything because you're only getting a percent on your money, which is about what inflation is at the moment in the UK, about 1%. So you're just not making anything. But, you've got a higher level of safety. John says that he has a part share in £170,000 retail Rolex. Yeah, They have a really good system too. I was talking to Unbolted about how they liquidate things. They've got a lot of context in the watch dealership world, so they're able to liquidate their items if they go into default very quickly, which is a big advantage. If you're an Unbolted lender, you'll probably see that you get a lot of emails saying that an item has been sold at auction, you're getting this much money back. So they have a very good network of being able to sell off the items that they're holding that have gone into default. And if they aren't able to sell it through their dealership network, they just put it up for auction and get rid of it. So that's one of the big advantages of investing through Unbolted is they're able to move things quickly when loans go into default, whereas a property loan takes forever to go through the system when it goes into default. So that's one thing that I do like about Unbolted. Again, if you have not joined the Lendy Action Group, which Mike is very active in on the Facebook, join them up right there. There was a talk too this week. I was reading on one of the forums about creating a rate setter action group, which was some pretty intense discussions about that. Some people saying, why are you creating an action group or proposing an action group for rate setter when, number one, this Metro Bank sale is about to go through that could potentially upset that? Or, why are you creating an action group on a company that's not in administration, is not in trouble? It's the rate setter is still pushing forward with its obligations to allow people to exit when it can. So why is there a need for an action group? And I kind of had the same feelings myself. I was thinking I wouldn't want to stir up a hornet's nest now at this point. Let the Metro Bank deal go through, and what do you have an action group for, anyways? At that point, maybe they're not doing things the way you want them to, but I've always had a good line of open communication with them. So I don't know. I don't think I would push for an action group for rate setter at the moment. Patty said, even with Metro riding to the rescue, taking a 10% hit might not be a bad idea. I don't know that rate setter is in a terrible position at the moment. And again, it just depends on whether you want to sleep at night. There's a good saying in the stock market that you only lose money when you sell. So a lot of people tend to sell at the wrong time. Exiting from rate setter might be at the wrong time right now to take that much of a hit. I guess I'm not. Is there some kind of an offer that you can get out at a 10% hit, or are you making a proposed something that may happen in the future? If it were to happen, would you do it? I don't know. On a 5-figure sum, would I do it? Again, it depends on my situation financially. If I'm a millionaire and that money is insignificant to me, then 10% of 5 figures, say it's 10,000. When you're talking about £1,000, it's not going to kill me to do it. But if it's a significant amount of money in my investment portfolio, then I'm going to think twice. You're welcome, Chicka Boy. Thank you for joining us. John said the £170,000 Rolex was recently purchased. Invoice seen by Unbolted, so I assume it was for investment. Yeah. Usually, sometimes those Rolexes can really appreciate in value. I know a couple of people that buy them when they come out and hold on to them. It has to be the right one. Some of the Rolexes don't appreciate like that, so maybe it's for an investment. But anyway, we're going to wrap it up right under the hour. Thanks again to everybody for joining. We'll see you again next Thursday. Again, leave a comment, leave a thumbs up, tell your friends about the stream, get everybody on here. And to anybody who's watching in the future, thank you for watching the video. And we will see you next Thursday. Have a great night, all. and be well. Take care.